This is a FarmDoc Daily Webinar. I'm University of Illinois Extension's Todd Gleason. Thank you for joining us on this Thursday. Today we'll explore factors affecting farmland markets. Our panelists for the day include Bruce Sherrick and Gary Schnitkey. We're glad to have them on board. And behind the scenes with us today is Jim Baltz. He's making sure that things go well throughout the webinar. If you have questions, please put them into the question box and we'll get those answered. Speaking of questions, we have one for you, a poll question to get us started for the day. Compared to 1 year ago, have farmland values in your area changed where you live? Have they increased by more than 20%, increased by 10 to 20%, increased by 0 to 10%? Stayed about the same or decreased in value compared to 1 year ago? We would like to thank, by the way, while you're filling out that poll, our sponsors for the day. They include the TIA Center for Farmland Research. You can find that online at farmland.illinois.edu. And Bruce Sherrick is the director of the Farmland Research Center here, based in Mumford Hall. Our other sponsors include Compeer Financial, Corteva Agri-Sciences, Farm Credit Illinois, FS Growmark, the Illinois Corn Growers Association, and the Illinois Soybean Association. So let's take a quick check and see how that poll is progressing for the day. Here are some of the answers. 12% of you say it's increased by more than 20%, and more than half of you say that it's increased by 10 to 20%. And then 26% say that, well, it's increased by at least 10% or somewhere in that range. Just 6%, Bruce Sherrick and Gary Schnitkey, say that it stayed the same, and nobody thinks that the value of farmland has decreased. What do you think of those answers to the poll?
Well, thanks, and good morning, everyone. Bruce Sherrick here, along with Gary Schnitkey. Looking forward to a conversation today about things that are near and dear to our heart. To the poll response, I think the folks that said that the farmland prices are staying about the same are the folks who are trying to buy farmland. I'd like to be able to say that the prices of used vehicles actually declined quite a bit if I were trying to buy one too, but I think the reality is we're above zero for sure. The 12% increased by more than 20. Auction results in the Western Illinois and into Iowa would suggest we're at least at 20 probably year over year. I think most of us, including the Fed, think we're in the 10% up range, somewhere 10 to 20 if you're in a strong market, 0 to 10 if you're not. So I think the poll results very clearly reflect what's really happening. So what we want to do today, though, is to kind of look at what are the impacts, what are the factors that impact farmland markets going forward. We'll use a little bit of history to make our points, but we're going to start with the fact that look at this long-term chart on the right. We have had from 1970 on, we keep really good data from 70 on. We keep fairly good data prior to 70, but it's really important to look at this long-term trend and recognize what led to a couple of the bumps and blips. The 1980 to 1985 period, on a relative basis, was the only major decline in farmland values. The 09 blip down, kind of sympathetic response to the housing crisis, but otherwise we have this long, very stable upward appreciation in farmland prices. On top of that, you have the annual income to account for if we're going to look at the returns to farmland. And we're going to go back and forth today between what impacts farmland values and what impacts farmland returns. In any case, recent price increases over the last year, maybe 18 months, maybe 6 months, depending on where you are, have been incredibly strong. And transaction volume is above norms, and that's a very stable effect as well. When we go through our Department of Revenue transaction data, we find that about 1.5%, a little bit more some years, of farmland turns over year to year on an arm's length basis. Now, much more than that is retitled, of course, but on an arm's length basis. So we want to look for what might explain the transaction volume as well. Let's see, Jim, can I run this? There we go. So let's look at a few things. Well, clearly over the last 18 months, we have had a period of time that's really difficult to use to compare to any other point in history. We've had COVID-19, massive financial support, massive stimulus payments, massive changes in consumer behavior, and interest rate markets as well, that have been held at a particular target level by federal policy that, again, is at, frankly, an unprecedented scale. We've printed Some people will cite the point, it depends how you count money in circulation versus total money supply, but we printed perhaps 30% of the currency that's in existence in the last 18 months. We've had these massive signs of inflation appearing, and we have some graphs coming up to help kind of put that in context. But we have, various debates. Is this a permanent sign of inflation? Is this transitory? Automobile prices, one that we'll show in a minute, very high, but perhaps that's because we had a chip shortage and it was just a shortage-induced economy, which is the title of The Economist magazine this week too, the shortage economy. Is that permanent or is it transitory? It's a very important thing to work out before we decide what it's going to do to farmland prices. We've also had recovered commodity prices, and we have prospects for demand growth that look very strong as well going forward. So I think if you were to look at 5 years ago and the prices we got for corn, and then look at this kind of period of time to make a comparison, you'd say, well, it's stronger, but is that permanent? Well, one way to look at that is to look at the forward rate markets implied by the futures markets. And in fact, we are at a different commodity price level. We also have really different tone coming out of Washington. We've changed our policy targets, perhaps, in the Farm Bill. We changed some priorities, perhaps. And we have had this encroachment into the ag policy of climate-related effects and sustainability effects that are probably going to be part of the way we implement certain policy targets for payments that go out to the farm gate. I think that's important to get a handle on. And we also have had two major tax proposals. Don't know how they're both going to work out, but concern about increasing capital gains taxes and concern about the potential loss of estate step-up provisions. The latter of those two largely gone away, it seems, for this current round. But continued concern about tax policies and folks who don't have a long-term engagement with their farmland seem to be taking a little bit more than normal. The idea that selling it now could be a good idea. Finally, we have low interest rates still and continued. And you might be getting tired of hearing us talk about that. And the idea of a low interest rate is that you get what's called a multiple expansion, or you'll pay more for future income. That's, of course, happened in equity markets as well. We've had incredible response since the beginning of COVID in the equity markets, prices up significantly this year as well. But the question is, if that were to change, what would be the impact on equities versus real estate? So we'll kind of go through those we'll go through those topics, we'll go through some data, we'll make some arguments, and we'll try to have a conversation about what we think is going to influence us going forward. I want to start with just some basic level setting. 2021 Farmland Values, as indicated by USDA, they perform a mid-year survey and release it in August, come up with a pretty good number. People will say, oh, these are always way too low. Well, they are lower than you might think of as commercial farmland because they average everything in the state that counts as farmland. So yes, these do tend to be low. Somehow Florida came off that page. Florida was 60-20 in case you're taking notes on any of this. But the changes year to year are actually pretty accurate in terms of percentage changes. We find that whether we compare auctions year to year or transfers from Department of Revenue year to year. So I want to use this kind of like you may have heard, a thermometer that's always 5 degrees too low is still perfectly useful. Farmland values have increased rather dramatically, 7 or 8, 9, 10% in some regions. Look at California and Oregon in particular. Western side of the Corn Belt, very strong, 11, 10.5. We have some numbers. And remember that this is for all farmland, and this is still only mid-year. As we went out of second quarter into third and started seeing, again, additional auction activity and other transfers, I'm very, very confident these are very low numbers. And traditionally, the fourth quarter and first quarter are the periods that most transactions occur anyhow. So there's almost no doubt in my mind that these numbers are going to continue to move up. And again, this is just farmland value increases. This is not the income. We'll have to talk about why that will translate to those numbers and what we expect. Two other ways to look at this by region. I want to stress that these, again, are not weighted by the amount of farmland. These are just raw prices through time. Pacific West, essentially California. Northeast, not much farmland. The ones that matter, of course, are the Corn Belt, Lake States, Northern Plains, Delta, and Pacific Northwest, in addition to California. So looking at these, we see again kind of a remarkable tip up in this last year. I want to try to make sense out of that and think about whether or not it's moving like that into the future or whether that was a one period effect. We'll go through these in one other way. That's all starting in 1991. I like to use the 1990 period roughly as the starting point for a lot of these historic comparisons because we can also compare to NACREIF. Sorry if there's a little bit of outside noise outside Mumford bleeding in through the mic today. It sounds like a little construction project might be happening outside our building. If we can also think about this just as a percentage change. So what's hard about looking at this graph is the starting point. If we just said percent change since 1991, again, Corn Belt, Lake States, Pac West, and Delta and Pacific Northwest, the ones kind of in the middle are the critical ones to look at. That's where all the volume happens. Mountain states, difficult to separate recreational from farmland. Northern Plains also strong, but started at very low price numbers. And Northeast and Appalachia don't really have a whole bunch of farmland in them. So, okay, so here's where the meat of today happens. Let's start by saying, can we learn something from looking at the historic inflation and interest rates? This is a very busy chart. I admit this is a complicated thing to consume all at once, so we'll try to do it in small bites. From left to right, roughly 1965 to present. Present is in the middle of the month, so by the time we get to 2 weeks from now, we'll have slightly increased numbers there as well. But the red line is the 10-year Treasury rate, or what you would think of as the reference interest rate. The number one interest rate the economy relies on is the CMT 10. We use that as a proxy for the cost of capital. We add credit risk and term to that to look at mortgage rates. And then the blue line is just a measure of inflation. The blue line as a measure of inflation has some very important epochs to kind of look at. And I put a couple of these up a little too soon, but if we think about the gold standard ending and inflation beginning to increase, think of the period through the 70s up to about 1980, when we said, oh gosh, we can't let this go. And we had nominal interest rates, farm mortgage interest rates that were north of 15%. So think about that compared to today, where a 30-year mortgage might be around 4%, in some cases for housing quite a bit lower, some cases for farms a little bit higher, but in that 3 to 4% range, a lot of our mortgage money is taking place compared to the 80s when it was, again, north of 15. And we put the brakes on inflation and said we really can't control an economy where we have that high of an interest rate and inflation complex. They get too crazy. The interactions aren't predictable. And from about 1986 through about 2008 and the start of the housing crisis, we had what we think of as the ideal and the intended, which is interest rates a bit above, real interest rates a bit above the level of inflation. Now, again, I apologize if this is just way too academic at this point. And it may sound that way, but it leads to what we're going to do to talk about going forward. If we have what we would think of as a normal relationship, cap rates above inflation rates, we know what we're going to pay for an asset that generates income. We can make predictions based on what changes in the other elements. Well, again, I'm just trying to catch up to my own slide here. What happened in 2008 was an external shock. This was not something that we said is just a normal going on of business. What happened at the beginning of 2020, likewise, a shock. Something we couldn't have predicted, the coronavirus pandemic and what it would have done to markets going forward. But we do want to use this history to learn something about what we might expect if inflation returns in particular, or if inflation doesn't return. And if we normalize interest rate targets, or if we don't. And then I'll make some arguments, and Gary, please chime in wherever I missed the salient points about what we think is going to happen there. This idea that we have this little measure of, trying to get my circle, there we go, this little measure blip up of inflation at the end of the period is really critical to understand. It's kind of been described as the shortage economy. We have this increase in prices because we ran out or had a gap in the supply channel somewhere, or we can't get new cars on the lot because of a chip shortage. We have a housing increase because people didn't have to go to work anymore and wanted to stay in the burbs. all these elements, or we have, early parts of that, the components of price inflation related to food were very positive. So let's see if we can make some sense out of that going forward. What will happen going forward after we have kind of gotten back out of, assuming we ever get back out of the coronavirus period we're in? This is a really interesting long-term price chart that says the components of inflation that add up to the total. Some that I think are important to look at to kind of calibrate our thinking. Green, food away from home. Even though we consumed a lot less food away from home during the last 18 months, the price increased a little bit. The amount we consumed went way down. The food we consumed at home went way up. And at the beginning of the recession around May of 2020, we have the red line spiking sharply. And when you pay more for food at a grocery store and consume it at home, a bigger part of that is available for the farm gate payment. It's kind of come back down, kind of come back up. It's kind of wobbling around. Part of this was there's a big, impact on the beef supply channels and so on. But we're kind of above the fraction of the total CPI that's represented by food is pretty high. The blue line that goes way up at the top, of course, is the motor vehicle valuations. And those, of course, are off the chart, and we know that. We're trying to figure out what to do to come up with that. But we have some questions. Education costs, are they going to go up? Offices and retail, are they ever going to come back? Energy, up now, but will it come back down? Cost of food and other cost of food processing, so on. But the one we want to focus on is farmland as the fixed factor of production behind all of these other elements. So we want to ask you first. Our next poll question will be, do you think in the next 3 to 4 years, so calibrating for about 3 to 4 years, that inflation will exceed 3%, average 2 to 3% per year, average 1 to 2 per year, average 0 to 1 per year, or be negative?
So I just got, as you're answering that, it's sort of interesting as we look at that one slide, Bruce, we see inflation going up, but the Treasury note rate on 10 years not going up.
Absolutely.
So what do you make out of that? And obviously that then implies that real rates are fairly negative right now.
That's right. Absolutely. The divergence between those two is a very rare thing, and it's largely driven by specific policies. We have been buying bonds, driving the price up, which drives the rate down, and managing the short-term interest rate intentionally as a matter of public policy by taking specific positions by the government. There are other things behind it, of course. I don't want to be called out as missing basic economics, but it's largely intentional that while we're in this abnormal economic period, managing productivity growth, encouraging people to invest, encouraging investment in real assets has become one mechanism to try to respond to the problems we've had in the last year.
Bruce, before you get to the answers to the quick poll, just a reminder to the folks that they can put questions in anytime that they would like to, and we'll see them and get those answered too. So now I think you're ready for the answers to the poll.
And go. Our poll says you are 46% believe that the inflation exceeds 3% per year, 43% 2 to 3%, so almost 90% believe that inflation is going to be over 2%. I suppose that would say that you guys don't believe that it's transitory. Is the short answer to that. And we did have a comment here. Bloomberg commentary suggests that the shortage is not driven by capacity utilization, but rather items such as supply chain shocks, and that is most definitely true. Well, although if you're looking at fertilizer right now, you could make an argument that some of that is capacity shutdown. But I would agree with that commentator in saying it's the supply chain. And what's sort of interesting about this right now is that we're seeing these supply chain adjustments, and those supply chain adjustments are happening after the COVID event, and many of us probably thought they were going to happen more congruent with it. I mean, we got through the COVID the first year pretty well. Now is when we're really beginning to see those supply shocks. So,
absolutely. ability to use up inventory, replace inventory, predict the drawdown is a very complicated thing, of course, and the supply shocks were part of it. The question is whether it's permanent for other reasons as well. There was I may not be able to describe this appropriately because it was meant as a comedy or a funny meme, but I saw one, a friend forwarded me, which was the Fed saying, we've hired the world's best economists. We have the world's data at our disposal. And now we're trying to figure out why printing $8 trillion might have led to inflation. We'll get back to you, but we're going to fund it with a $2 trillion study to figure out why. So yeah. I think it is difficult. There are supply shocks. There are supply channel massive disruptions. However, there were also massive monetary effects that we have to actually work through the system as well.
There is another comment here. Are wage and cost of labor included in the CPI?
I didn't show the wage component. The wage component of inflation is very high. The one I chose to use here was consumable items. So if you go to the BLS website, you can pick any particular version of these you want. Wage inflation, again, questions about whether it's transitory because people are hesitant to return to work, have had reasonably strong support from other channels and don't need to work perhaps. We also have, it's difficult to distribute stimulus in a uniform way. So we have very high savings rates among those who got stimulus and didn't need it and so on. So we're going to move on. We'll get to a couple other questions perhaps. But we'll look first at a long-term period comparing farmland returns and farmland returns minus inflation. So if we were to look at the spread, first of all, the rate of return you got, and this is price appreciation plus income and the CPI, and then calculate the difference between the two, we get a really remarkable long-term relationship. In 1985, again, when we had what I'll call the lender-induced farm crisis, or farmland was going up and we had a perfect storm, we ended up with a grain embargo, an oil crisis, and a major shock in interest rate levels, and interest rates of 15 to 18% on farms that weren't serviceable when we brought those back down. And then we said, no, let's actually manage both sides of the economy. 2009, likewise, I believe is just a sympathetic blip to the housing crisis. I don't actually believe that people suffered that much on the ag side in 2009. But we want to look at these by decade. From 70s to 79, the farmland return to CPI spread was 11%, or roughly 2/3 of the total level of the interest rates. And if that pattern kind of continues, 1990, 1999, 6, 2000 to 2009, almost 8, 2010 to 2020, 5, and over that long 50-year period, it's 6%. Is that going to be the result we have going forward? And if so, what would the impact be on farmland prices, even after 20% increase? Or maybe that was too much, maybe it's too little. But I want to point out that we have a different monetary regime now than we did in the 70s and 80s. We probably are entering a different demand regime, and we have definitely a different crop insurance regime. Since the 80s, we've continued to improve and create mechanisms to ensure, kind of cut off the tail of left-hand side revenue risk on what I'll think of as row crop production. So we're going to keep moving, get to some of the questions as we have time, but want to kind of put a context around that prior graph as well. These numbers change a little bit year to year. If you've seen this graph, I continue to use it and update it. USDA refines and modifies their projections each year for several years into the back. So, but I think the numbers are about right still. Again, it's within orders of magnitude of being right. So 2.5 trillion, that's 2.5 trillion with a T, value of farm real estate, but only 13.9% debt on a total basis. Farmland represents 83% or so of the assets. You would expect it to be 83% of that debt, but it's not. Real estate debt divided by total debt is only 65%. So for many, I think institutional investors or absentee landowners simply looking at the asset class and saying, gosh, I could buy an asset, put long-term debt on it at a higher level than 13.9%, and perhaps in a rational sense, lever my investment in a safe asset better than I can do in the stock market. that becomes an interesting and very valuable, very useful way of thinking about it. It seems like that has become a newly discovered idea every 5 years. And about 5 years ago, I was, pretty much on the record saying, gosh, this is all of a sudden generating a whole bunch of additional interest in owning farmland by individuals, by absentee owners, by people like me. I'd like to own more farmland, by pension plans, by state university pension plans as well. And it does make a lot of sense on the long-term basis. Looking at that in a slightly different way, this is a chart that I update every time I can. The bottom components, the Treasury, 10-year, the S&P 500, the gold, and the CPI can only be updated at the end of the year for meaningful comparisons to farmland, which really only have an annual income cycle. So farmland, we can make estimates that are pretty accurate mid-year. So I've done that for the elements above the dotted line. And if you combine the 32 top ag producing states, my estimate from 1990 to 2021 is a total annual return of 8.6 per year and a standard deviation of only 3.7%. I'll go a little more slowly through some of this and then skip forward because there's still a lot to cover. But the individual states, you'll see, have numbers that are kind of commensurate with that, but a little bit more risk because when you combine them all together, you get the portfolio effect. They're all still pretty remarkable numbers, though. Washington, 13.6, Nebraska, 11.5, Kansas, 10 almost, Iowa, 10.6, Minnesota, 10.4. Standard deviations that are less than half or around half in many cases, and highly correlated. So where you have farmland, it's highly correlated with other farmlands. So do I have to buy in Iowa? Can I buy in Illinois instead? Do I have to buy in Indiana? Those are reasonable questions that say, well, it doesn't matter that much. Minimum return or the maximum drawdown, another way to say it. Iowa had a 5.3 decline at one year. Again, it's probably 2009. Probably not totally real. Maximum returns, though, in any given year in the 20s, really quite an attractive return profile. If you're to go down to the financials at the bottom, Treasuries, considered the safest investment in the world, 4.39, and a standard deviation that's not much lower. And on a relative basis, the coefficient of variation, the relative risk per unit of return, doesn't look any different than farmland. So if you can get a higher coupon from farmland with about the same risk, it seems attractive to some people. The S&P, this number will go up this number will go up some after this year because we're, plowing ahead in the equity markets. But on a 30-year basis, that 762 is still not going to challenge farmland in a massive way. Any given year, if you're really good at timing and picking stocks, great. You should be in the equity markets and run a hedge fund and pick stocks. If you're looking for a more long-term design in your investment strategy, or if you're a farmer and need to plan on the long-term family wealth questions, this, again, still looks very attractive to me. Gold, we include it because everybody's always fascinated about it when it's in a period of inflation, may have good returns in periods of direct inflation. And the CPI has averaged about 2.3 through that period of time. Now, this is a very complicated screen as well. The other thing to think about that I've done here on this screen is just take each of the NACREIF regions, but use the USDA data and data we maintain here in the center to create analogs. If you were to own all of the Delta, all of the Lake, all of the Southeast Mountain, Pacific West, and so on states in a portfolio, what would your 1 year, 5, 10, 15, and 20-year return period have been? Holding period been. And again, what we see is, look at a 5-year or 10-year or 15-year, 20 years beginning to get back into a period of higher interest rates. So we expect that, the effect of inflation eroding that return was a little greater in that period of time. But again, a really quite remarkable long-term performance, I believe. And then the bottom three are only through the middle of this year. NACREIF is a remarkable organization, 13 billion plus of real estate accounted on an identical basis through time, divided into annual and permanent cropland. 1 year holding return on annual cropland, 7.7, permanent cropland, 0.3, largely represented by the commodity mix. Apples and almonds had a tough time a couple years ago and so on. But the total farmland index, 4.7 on a 1 year basis, 5 on a 5 year, almost 10 on a 10-year, and 12.5 on a 20-year holding period. Again, that's an absolute remarkable return. question, farmland return based on both cash return and appreciation. It's a little more complicated than that. Total farmland return, we use cash income in the form of cash rent plus appreciation minus property taxes, things we believe have to be paid out of the rental income, and divided by the previous period. And then we put it on a geometric compounding basis so that we can add it up through time and get a consistent number. And we don't have the problem that some people have, if you will, when they say things like, 100 minus 50% is 50, 50 plus 50% is 75, but you would not have gotten a correct number if you said the average rate of return was 0. So we correct for the algebraic problem with that. Property taxes, land management fees, commissions. No, we do not take out commissions, nor do we take out land management fees out of the NCREIF, but we do include net cash rent on the regions for farmland in the USDA data. There's a question about taxability as well and transaction costs. Of course, it's very expensive to buy and sell farmland relative to logging onto your phone and buying or selling a share of Nike stock. There's also, though, the ability to defer taxes much more easily on farmland than there is in a stock that you're buying and selling 7 times a year. So yeah, there are different ways of doing it, and I appreciate the comment, the question about being somewhat skeptical about the numbers. We've worked pretty hard to try to reflect what we think is the actual ex post performance had you been in that position, but you are completely correct that we don't take out buy sell costs, and a round trip in farmland is probably still a 4% cost. So if you're going to hold it for 20 years, 4% divided by 20 is still a number. Anything else on that, or I think I'd like to go on just in the interest of time. Farmland price appreciation, this one does not have income in it. So in addition, I just think this is a neat way to think about it. This is a different presentation than I typically use, but kind of encountered it from some work I'm doing to try to keep track of how NCREIF and other funds and private funds might have held up their value based on when they were formed. So if you bought everything in 2000 in California, you're up 263% at this point in time. If you bought everything in Illinois in 2002, you're up 236%. If you were in, say, Oregon and bought everything in 2006, your price has appreciated 90% since that date. So it gives you a little bit of a sense of the variability year to year by region, by location. I didn't just pick some of the interesting states, but the last column, the 2020 column, is 2022 today is roughly on par with the USDA price appreciation. There, in addition, by the way, to the question, very good question about do we include commissions and so on, there's a difference between total farmland and cropland. And I think cropland returns are a more meaningful way of looking at commercial scale agriculture, but USDA includes all farm real estate, and we have a historic splice in time that we have to be very careful with. So I often report farmland, but if I were doing an individual property analysis, I would very much look at the cropland data instead. This one, complex picture again, but really, really very, very informational. Take a little time to orient it. But this last front right, bottom right corner is something really to pay attention to. What we have on the bottom front axis is time from 2003 to present. What we have on the vertical axis is the yield on treasuries. And what we have going back into the depth of the chart, that T1M, T3M, and so on, is the term to maturity of the treasury security you're buying. So in the, before the housing crisis time, we had this, wavy scalloping kind of yield curve. And then September 19, 2008, the world changed, probably forever. And the overnight market shut down, and we had this long period. I like to call it the liquidity puddle because it's blue on this chart at the front end of the yield curve, where we made banks hold twice as much equity. We made the balance sheet of the Fed giant and still giant. We had all kinds of efforts to keep interest rates low and slowly changing throughout the recovery from the housing crisis. Then we got to end of 2015, beginning of 2016, and we said, okay, all bets are off. You guys can go back to working your own life again. The face cliff, if you will, I don't know how my pointer might or might not show up on the screen there, the face cliff here, the sheer face cliff, if my pointer is coming through, looks a lot like September 19, 2008, when we have a massive government intervention and we say we're going to manage the short-term interest rates again. We got to that point and said, well, coronavirus, until we're done, we're going to enact practices to keep long-term rates low and short-term rates low. And we see that the economy is beginning to fight that a little bit at the long end of the yield curve. And we're getting all of these pieces of evidence that inflation is going to return. We really need to think, though, about how this is going to resolve itself in the next, presume that we get some normalization and get back to work in person and do things that happen after we're through this period of time. What will that look like, and what does it mean for real estate values is really the set of questions we want to go to now. Here's another way of looking at the same data, but tells the same story perhaps in a more compelling way. If we were to take the first trading day of each year from 18, 19, 20, and 21, those are the solid lines and the yield curves on those days. Of course, the black one, 2021, we were still in the throes of the coronavirus issues. And what has happened since then is that expectations are that long-term economic activities are going to return. We have an ability to use the trade data from interest rate markets to project what we believe people think forward rates will be. That's a really critical way of thinking about that relationship between farmland values and what's going to happen going forward. And we'll talk about that in the context of what you would pay for money going forward. Here's a slide that, Gary, I think you put this kind of idea together first, but very simple. And, maybe you want to kind of walk through what the idea here is, but cash rent as a proxy for current income and growth through time really let us talk about what a rational value of farmland would be if you treated it as an absolute financial investment.
Yep. And what we're doing here is looking at the current return, which is a cash rent, and then dividing that out by the required rate of return and the growth rate, and coming up with the capitalized value here. So over time, as you look at this, we've had the current cash rent, which is our current return. We're going to measure the required rate of growth as a 10-year Treasury note, and therefore we do get these sort of variations here. If you're looking at the 10-year Treasury rate on the right-hand side, and then look at Illinois rent to value, one of the things that you'll notice is that on that gray line, if you look at the gray line up here, this is the 10-year Treasury note rate. And then all of these Illinois rent versus the value of farmland. And this is Iowa, here is Illinois, and here is Indiana. One of the things that you'll notice that they do very, very closely match what is going on with the 10-year Treasury rate, except for this period back here in the 1980s. And then during that period, during the 1980s, we saw 10-year Treasury notes go up and the rent to value ratio go down. One of the things to note about this area, this was the area. This is the area when we had that sharp decline in farmland prices, and therefore we had this. That was a concern. We do not see that concern currently because rent to values are near, or actually above, the 10-year Treasury note. The bottom graph sort of gives this view again, but in a different way. If you look at these lines, if these are what our capitalization values would say that the farmland value should be, and they're significantly above what it currently is. And that is what we're saying is that the market is actually being conservative and not building in the fact that you could make several arguments, but one of those is that the return, or excuse me, the interest rates, Treasury notes aren't going to stay as low as they are. Which may or may not be a good assumption.
Well, no, I mean, this is going to lead, and we're going to have a poll in one more slide here, but a couple of things to add to these comments. excuse me, this sort of signals that the rational farmland investor thinks that rates are artificially low, or that there's still room to run on farmland values. And again, if you just look at charts as a technician and go, gosh, when something goes up, it's more likely to come down, or when something goes down, it's more likely to come up, you might come to different conclusions. But from 2013 all the way through 2021, interest rates have been below what you can earn in farmland. So it's natural to expect that the interest in investing in a treasury-like security about the same risk at a higher coupon would be good. But Gary's exactly right. What that indicates is that there's quite a bit of room to run. There's a lot of chance for farmland markets to continue to go up, especially if interest rates stay relatively low and if inflation doesn't return in a way that pulls interest rates back up. The 2.95, I'll comment, kind of reiterate that just to say, if all you did was to say, what is the implied 10-year rate, or I'm sorry, the implied cap rate in farmland from current returns, in those three states shown, middle of the Corn Belt, it's 2.93, 2.95. So that's a pretty strong indicator that the expected current yield of 2.95 plus the expected appreciation, again, is going to be way higher than treasuries. One of the questions real quickly, current debt to asset and debt to equity ratios for the universe of S&P 500 companies. If you were to combine all of the S&P companies, or actually I'll do the New York Stock Exchange, even broader. If you were to combine all of the companies on the New York Stock Exchange onto a single balance sheet, it would be about 66% debt. Sometimes a little higher, sometimes a little lower. Moody's and S&P do a study every year, and you can kind of look at it that way. But debt is much cheaper than equity. So a publicly traded company, you would expect to be more than half debt.
By the way, then they've been lowering that debt levels in recent times for a variety of reasons. We had a question here. By the way, while we're doing this, why don't you guys take a poll for us, and then so we have a question. Do you expect the Fed to taper QE and possibly raise rates in 2020 at the expense of slowing GDP, etc.? What do you think, Bruce?
Well, again, as you're taking the poll, this is a one-year question on the farmland values on the poll, but do we expect the Fed to taper? Well, we keep getting signals that they have to at some point, correct? There's just no ability to continue to manage it. And this balancing act of not, slowing down the economy, not getting into a stagflation effect where you have inflation but not productivity gain. Would they slow in 2022? The dot plots have been kind of in advance of real Fed activities, forecasting that for some time now. The most recent Fed guidance essentially says probably beginning shortly around 2022. Will that slow GDP? One would expect it to. Effect on equity and housing markets. Well, equities in particularly growth stocks, as soon as you raise rates, the cost of future income or the value of future income tends to go down. So you kind of get this. If you listen to the financial news, you get these things people call rotation out of growth or rotation out of the long-term tech growth stuff. Housing markets, that's unclear to me because housing, like farmland, is in the long run highly correlated with inflation. Mortgage rates, though, which in the short term when they go down and you can quickly afford a whole lot more house, that happens a lot. And so we have had like these regional housing inflation effects. And then the effect of higher interest rates to national debt. It's actually very scary to, those of us who are worrying about our kids' future. The total servicing of debt continues to grow. It's not a huge fraction of GDP right now, but it's meaningful enough that you can't print, 8 trillion or 3 trillion. You can't print that much money every year. The arguments of, this is akin to a war. During a war, you can leverage your future and expect productivity growth in the out years to catch back up. But in this case, I think it's a little harder to make the argument that we didn't overprint money. So the poll results, Gary, what do you think of those?
So do you expect farmland values in 1 year to some 33% increase by 33 or more than 5%, 60% between 0 and 5%. So we got 93% that think it's going to rise, 6% saying stay the same. So only 2% think that they're going to fall. So we're pretty optimistic about next year. I suppose the optimism has to be tempered a little bit by noting that you can't have large increases like we had this year continually. So
well, surely if we were going to get 20% a year forever, I'd just buy all I could now. And the difficulty is, of course, buying it now. I pretty much agree with the poll, but I would be on the optimistic end. If I look at the prospects for income and the ability to manage both insurance and input prices and marketing for out years, I think it's a reasonably positive position as well. This slide is just another final financial kind of presentation on how to think about what happens as you hold something for a longer and longer period of time. So if we were to look at the U.S. ag returns in total and say what happens if you have a 1 year rolling, in other words, you're just going to buy it and hold it for a year, what's the likelihood of it being related to each of these other instruments across the top? The PPI, Producer Price Index, a little stronger measure with farmland because it's related to input prices. CPI, general inflation in the economy. Gold, thought of as an inflation hedge. So the first three are kind of like does farmland store the value of purchasing in the future very well or not? And then the red ones are fixed income. And then the last three are versions of equity market stocks, whether it's listed real estate is in the form of REITs, so it behaves more like a stock. And then European equities and US equities. So what's remarkable is the longer you hold farmland, the stronger its ability to protect against inflation becomes, as proxied by PPI and CPI taken together. Still very positively correlated with fixed income and negatively correlated with equities, and probably stronger the longer you hold it. So as an inflation hedge, it's a good idea. As a diversifying asset, it's also very good. Great question. Has there been a move away from investments in retail and commercial real estate due to pandemic? We follow NCREIF as our model of that, and there are a couple of indices that NCREIF publishes rather routinely, and it's really hard to get. It'd be very hard to be optimistic about the return to rental rates in major city centers. Major concern in my mind about will we ever go back to the middle of cities as the basis for where we sit while we're doing work. So I expect that to be a negative. Good question on cryptocurrency. Bitcoin is the proxy for that. We'll maybe have a chance to visit about that in a minute. But just again, we're getting a little tight on time. I'll go through the last couple of slides kind of quickly. But in addition to inflation, I want to point out that you can't use what you view in the popular press or kind of general financial press about the strength of the dollar when it's a total trade-weighted dollar index to say something about agriculture. Why? We export more agricultural products than we import, and we import more of everything else than we export. So in agriculture, you get kind of this reverse effect. So your view on the impact for the ability to buy imports or bring things into the country, we all want to buy a 60-inch TV for $300. That's really good if we have a strong dollar, but that makes it harder to export corn and soybeans and ethanol and so on. So this is just some of our major trading partners, and it's put on a basis where I zeroed it out. This is a great chart available at the Fed now as a standard one, but you zero it out at around the beginning of the pandemic and say everything is on an index of 100. So at the beginning of 2020, we said today's exchange rates that balanced our world trade, and then said what happened during the pandemic and since. And what you get is, think of it in this simple form. They're all expressed in an external currency: Mexico, China, Euro, UK, Canada, Brazil. They're all expressed in how many of that unit of currency you need to buy $1 US. So if you need a lot more pesos or real or external currency to buy a dollar, the line will be above 100. If you need less, the line will be below 100. If you need less, you can buy more of the things you're buying from the US, which favors agriculture. So look at the Canadian, China, Euro, UK lines are all in the, relative to the beginning of the pandemic, making the demand for commodities a bit more affordable. We don't sell that much to Brazil or Mexico of our major middle of the country exports, but we do have massive trade with Mexico and Canada in particular. So just to say it's complicated because it's reversed from the impact on the majority of the rest of the economy. And secondly, it depends on the strength of the trading partner in agricultural commodities. So just warning you that it's difficult to look every day and say, Bloomberg's trade weighted dollar index went up or down. Doesn't help us explain agriculture as well. I think this bodes very well, frankly, if you do the fractions by trading partner of export of corn and soybeans, it bodes pretty well for the future for Midwest agriculture. So here are the things we want to kind of finish with and get to some questions. Key issues impacting farmland. Are we going to have inflation? Most of you thought so. Is it going to be 3, 4, 5%? If so, that's probably really good, unless we resolve the term structure in a way that creates stagflation. Then it's a little harder to see. We have had now for about 2 years, the Federal Open Market Committee stance saying we're going to manage interest rate markets differently than we did in the past, and we're going to keep them low until we're out of the pandemic. It's really hard, though, to get people off that particular kind of drug of cheap money. Transitory or permanent inflation, we have kind of a raging and increasing debate in the financial press about that. We really can't know, though, until you take the artificial flows in the money markets out. So until tapering decisions become more real, until we actually start to pull out of the bond market as the Fed, we really can't, I can't answer that. I think it really matters, though, that we continue to have China grow well and the rest of the world grow well, because the demand for meat products in particular, where you have to multiply up the number of calories that you got from corn or soybeans, is expanding. I get The Economist magazine and immediately flip to the second to back page, where you can look at the productivity growth of all the countries around the world and people who buy our commodities. China, 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 first three I look at. But if you can continue to grow the middle class in the developing and the developed world to continue to buy more meat, that's really good for the middle of the U.S. Finally, this is a really important one. There's a webinar this afternoon with People's Company that's going to look at this in more detail, but tax policy impacts seem to have really brought people out of the woodwork. There's more buyers and more sellers because we've had we've had really high incomes, so farmers are back in the market. And we've had a lot of people who were some version of an investor say, gosh, I'd like to get rid of this now because I'm worried about higher capital gains tax, and early in the year about potential inability to get a step up in basis. Water, major issue. We haven't talked enough about this because we're sitting in Illinois. Too much water today. It's raining here. But water issues that are creating pressures, especially in Southern California, where Sigma may have an effect. Ethanol demand and use of corn in energy markets. Are electric vehicles really going to push them out? Farm Bill title and use of federal programs for new agendas, because the bottom two here are really critical. I'll go back to the top for just a second. Discovered a couple of initiatives, one of which is actually named the New California Project, to try to get what I would call vegetable and small grain production moved, or things like processing tomatoes, moved to different parts of the country where there is plentiful water, so that the cost of water as a fraction of the cost of the production could be managed relative to California. California markets are complex because they're water-driven and population-driven. I would say that lower parts of the Mississippi Delta are not yet driven by either of those effects. It could be a place you could, for example, grow more tomatoes if needed. Farm Bill, last thing that we'll talk about in a kind of a challenging way. If what we do is say that we really do want to reduce the amount of carbon in some way, and we look around, the only place to really store carbon is in the soil. The original solar collector, of course, is a plant. And if we're going to have a federal program whose agenda is primarily to mitigate climate effects by storing carbon, agriculture becomes part of the solution rather than part of the problem. And there are lots of things going on now in the federal conversation about how to do that. Do we incentivize people, or do we require it, or do we create an external market for carbon, or do we have a crop insurance program that helps promote different practices, or do we just simply pay directly for practices? There's also a private market group of people, thousands of millions of dollars, I should say, being spent on just developing an understanding of how to pay people for activities. So when the Microsofts and the BlackRocks and the Walmarts make a claim that they're going to be carbon neutral, and they look around, they're going to have to start paying places like Farmland to do a different practice to try to offset their own footprint. So with that, we'll get to our we'll go to our last little poll here. Oops, one more slide before that. Consumer preferences and sustainability goals kind of indicated that in the prior one. And the last point on this one, these are slightly redundant and slightly similar. Rental markets are really slow moving. It's really hard to go from a $270 cash rent to a $300 cash rent in 1 year, for example, at a state level. Individual markets do, but we may begin to integrate other effects into our cash rent contracts. So carbon payments that come to the landowner may require no-till or rotation or nitrogen management, or I'm just making these up on the fly. But it does seem like we're going to begin to more formally manage practices at the producer level, and that will end up being implemented through some version of a rental contract. Crop insurance has been improving through years. A couple of financialization points. Again, I'm a little confused on my own slides here because Jim made them look a lot better, so some of them are on multiple slides when I was expecting them to be two. But the last point here is kind of a critical one. I've been talking about this financialization of the asset class for at least 10 years. And somebody at a conference a couple of weeks ago told me, you've been saying we're 2 years away now for the last 10 years. And they're kind of right. But this year we have had additional REITs, additional ETFs, and additional adjacency funds that target agriculture and carbon-based parts in agriculture. We've had these decentralized finance vehicles. DeFi is just short for DeFi, decentralized finance, including crypto versions like Magma, Acre Trader, Farm Together, Steward, these individual vehicles where you can buy $5,000 of a farm while you're walking around on your lunch break. It's a little more complicated than that, but it's definitely where it's headed. And institutional investors and large high net worth individual positions are beginning to really pop up again, showing up at every place, including not just buying land for themselves, but buying land for a farmer so that a farmer can expand. And finally, I think it's really critical. The major ag lenders have expanded the total amount of debt, but the total amount of debt as a fraction of asset values has not made any gain because asset values went up even more than the amount of debt. So I think that's kind of the end. We'll move to our poll. We're going to go to a 5-year out. Do you expect farmland values in 5 years to increase by more than 5 a year, 2 to 5 a year, 0 to 2, 0 to 1, or decline? And that's a 5-year sense. So this is us asking you kind of what asset would you rather own? Do you actually believe in this asset class or not?
All right, so if you're taking this poll here, as you complete this poll, we appreciate your time today. And we're going to see where you're all at thinking about expected farmland values in 5 years from now. So you're almost 70% voted. So let's take you to that poll results. And most of you believe, 55% believe that that will be 10 to 25% higher. And most of you, except for 5%. 5% are the believe that farmland prices will be lower. We appreciate you and you taking our time here. And Todd, do you want to tell us what's coming up here?
You bet. We've got another webinar. This is the last in the FarmDoc Daily Fall Updates series. Next week, Gary Schnitkey will be back along with Dale Latz. They'll talk about machinery cost and management. They've updated some of those numbers. You'll want to be here for that. Again, that's machinery cost and management. If you're here today, you'll get an email automatically next week reminding you that that's coming up. We also would like to thank our sponsors for the day. They include Compeer Financial, the TIA Center for Farmland Research, which Bruce Sherrick directs, Corteva Agrisciences, Farm Credit Illinois, the Illinois Corn Growers Association, FS Growmark, the Gardner Ag Policy Program, the Illinois Soybean Association, and the University of Illinois College of Agricultural and Environmental Sciences, along with the Department of Agricultural and Consumer Economics. One last note, and we'll maybe get one more question on whether we have just a little bit of time to do that or not. But if you want to check the archive of this series out, you can do that on our website at farmdocdaily.illinois.edu. You'll find not only YouTube videos there at that website underneath the webinar section, you'll also find a way to download the PDF files of the PowerPoints if you want. And if you just want to follow along with all the YouTubes, that's pretty simple too. You can go to youtube.com/farmdoc video. That's down there at the bottom. And you'll find not only these, but the 5-minute farm docs and some other things. So if you want to subscribe to our YouTube channel, you can. Gary and Bruce, anything else before we say goodbye for the day?
Well, we got a couple questions here. We have this question. What's your thoughts about rational expectations effect on consumers, employers, and workers incorporating higher oncoming prices into their current behavior and decisions?
I'm glad we're ending on a simple one, huh? This is the question, right? So what do you expect the future prices to be, and whether or not there will be kind of a negotiation between the inputs, including wages and current behavior, in a sense? Permanent income hypothesis is similar to this as well. I think that's the question we're trying to figure out as we come out of the pandemic. Is this just a blip, or have people gotten to the position where there's a permanent change in the ability to negotiate? And the wage information, to me, as I look at the financial information that I study, the wage side is the hardest one, absolutely the hardest one to get a handle on.
So we had a question about what is the Social Security increase, and we don't know that. We had one comment here, and this is maybe a wise or a cynical comment, that the supply chain prices will come down slower than they went up. Yeah, we got that. That is usually what happens in these sort of things. We'll end here with one question about. All right, so.
There's a IFAS question at the bottom too. We probably should announce that.
Yes, we do have the dates for IFAS.
I can take care of that.
All right, go ahead, Tom.
You go ahead and answer the question, and I'll close out with that, with the IFAS dates.
All right. So, do we expect more? Bruce, you expect more outside investment coming up?
I do. I think the separation of ownership and operation is a natural thing that's beginning to occur. Again, I've been wrong on this for 10 years in a row on the pace, but correct for 10 years in a row on the direction. A farmer who owns all of their own land, or a farmer who rents 50% of their land, or a farmer who rents 70% of their land are different financial operations, frankly. And the scale needed to be competitive is quite often not consistent with owning all of your own land. So Illinois and Iowa tend to have very rational compositions. 60-40 tends to be kind of a number that turns out to be very efficient. But there's, a $600,000 combine and a $400,000 tractor and $300,000 in your, old planter. Those kind of things begin to make it sensible to separate ownership and operation in certain cases. There are also tax advantages sometimes for doing that, and I expect that to continue. But mostly it's because the outside investors need access to this asset class. And so it becomes an advantage to the existing owners to participate in that. It's an example that I try to always use the same way. I don't think when you buy a pair of Nike shoes, you care if the Nike shoes were made by people who own the factory. in agriculture, we kind of have a public policy that does kind of do that. And we have a natural expectation for individual ownership of farmland, which I support. I think it's really important to have those heterogeneous. I knew a lot about the farm I grew up on, and I could farm it better because of that local knowledge. But I couldn't have scaled it without access to debt or other forms of capital if I wanted to get it to a commercially viable size. So I think that's a perfectly normal progression through time. And I think it's very healthy for the ag and the rest of the investing economy for that to happen.
All right, we are coming to the close here. Todd, do you want to close it out and tell us when the IFAS meetings are?
I will, Gary, indeed. Thanks to Gary Schnitkey and Bruce Sherrick, both agricultural economists here on the Urbana-Champaign campus, for participating in this FarmDoc Daily webinar. And thanks to you as well for being on hand with us again. You can always find these up on our website at farmdocdaily.illinois.edu. And eventually you will find a link to the Illinois Farm Economics Summits. Those will be online again as webinars this year. And we do have dates for them that begin at the end of November this year. So Monday, November the 29th. These will all be at 11 o'clock, and we'll be posting 5 of them and hosting 5 webinars. And then they will be on Monday, Wednesday, and Friday that week, and then on Monday and Friday the following week. You can put those in your calendar. We'll bring you more information on those at the FarmDoc Daily website, farmdocdaily.illinois.edu. On behalf of Gary Schnitkey and Bruce Sherrick and Jim Baltz, who's behind the scenes today, we do thank you and really appreciate you staying with us for the full hour. I'm University of Illinois Extension farm broadcaster Todd Gleason.